What is capital gains tax? Well, imagine you're a farmer. You buy seeds at the start of the season, and after months of tending to your crops, you harvest and sell them at the market. The price you sell your produce for is higher than what you paid for the seeds. The difference between the cost of the seeds and the selling price of your produce is your capital gain. Now, let's take this analogy to the world of investments. When you buy an asset, like a stock or property, and later sell it for a higher price, the profit you make is your capital gain. But here's the catch. Just as the farmer might have to pay a fee to the market for selling his produce, you have to pay a tax on that gain. This tax is what we call capital gains tax. It's a fundamental part of financial planning and investing, so in essence, capital gains tax is the tax you pay on the profit you make from selling an asset. Now let's dive a little deeper into the types of capital gains. So imagine you're at a track and field event. There are two main races happening, a 100-meter sprint and a marathon. The sprint is quick, taking just seconds to complete, while the marathon, on the other hand, takes hours. This is a handy way to understand the difference between short-term and long-term capital gains. Short-term capital gains are like the sprint. These are profits from the sale of an investment or property that you've held for 1 year or less. The tax on these gains is typically higher, mirroring the high energy burst and quick completion of a sprint. In the United States, for example, short-term capital gains are taxed as ordinary income, which can range from 10% to 37%, depending on your income level. Long-term capital gains, on the other hand, are the marathon of this scenario. These are profits from the sale of an investment or property that you've held for more than a year. The tax on these gains is generally lower, reflecting the slower pace and longer duration of a marathon. In the United States, long-term capital gains are taxed at 0%, 15%, or 20%, once again depending on your income level. Both races, or types of gains, have their own strategies. Sprinters, or short-term investors, might look for quick wins, buying and selling within a short time frame to make a profit. Marathon runners, or long-term investors, are in it for the long haul, often investing in assets they believe will grow over time. Each strategy comes with its own risks and rewards. Short-term investing might give you quick returns, but the higher tax rate can eat into your profits. Long-term investing, while potentially slower to show profit, can provide substantial growth over time and benefit from a lower tax rate. So while short-term gains are like a quick sprint, long-term gains are more of a marathon, with different tax implications for each. You might be wondering, why would anyone choose to run a marathon when they could sprint instead? Well, let's consider this in the context of capital gains tax, and more specifically, the benefits of long-term capital gains tax over short-term. So picture this, you're baking a cake. Now you could throw all the ingredients together, whack it in the oven and hope for the best. That's your short-term approach. Sure, it's quick, but the cake might not turn out as you'd like. It could be undercooked, too sweet, or just downright inedible. On the other hand, if you take your time, measure your ingredients carefully, mix them thoroughly, and let the cake bake to perfection, you'll likely end up with a much more satisfying and rewarding result. This, my friends, is your long-term approach. Now let's translate this to capital gains tax. The short-term capital gains tax applies to assets held for a year or less. These gains are taxed as ordinary income, which can lead to a hefty tax bill, much like our rushed, inedible cake. On the contrary, long-term capital gains tax applies to assets held for more than a year and generally offers lower tax rates, which encourages long-term investment, fostering stability in the financial markets. The lower tax rates are a significant incentive. Long-term investing also allows for compounding, which can significantly boost your returns over time, much like the layers of flavor that develop in a cake when given enough time to bake and cool. So the next time you're considering your investment strategy, just remember, like our cake analogy, taking a long-term approach with capital gains can sometimes lead to greater rewards. So, to sum it all up, capital gains tax, in its simplest form, is a tax on the profit made from selling something that's increased in value. We also understand that capital gains tax isn't simply a one-size-fits-all affair, and it's always crucial to consider your individual financial circumstances and investment goals. If you enjoyed this video, go ahead and give it a like, and if you want more investing content, feel free to click that subscribe button and notification bell. If you did happen to subscribe, go ahead and leave a comment saying I subscribed. and I will personally give you my thanks and shout you out on the next video. Thanks again, everyone, and I'll see you in the next one.